Prop trading scam. The web of agents, brokers, and fake profits. It is morning. A trader logs in on his phone. Numbers are flashing on the screen. The P&L is green. The leverage is big. And the people sitting in front of him are assuring him that this is not some ordinary trading setup, but special access. At the beginning, everything looks professional. An office-like environment, market-like language, and dreams that look like profit. But this is where the fear begins. What if this entire system is not actually what it is being made to look like? And this is where the curiosity begins. How do some people build such a trading world without proper KYC, without a clear agreement, without a clean paper trail, in which profit is visible, but safety is nowhere to be seen? Moneycontrol's 2025 reports mention one such alleged network, in which losses of nearly 150 crore were feared and people from many cities came forward. This story is not just about one alleged scam. It is a story about the trust that was used in the name of market knowledge, fast returns, and exclusive access. Prop trading sounds like a very sophisticated term, but its basic meaning is simple. When a broker or trading member trades from its own account and with its own capital, that is called proprietary trading. Official exchange, FAQs, and regulatory material also say the same thing. That a prop account is the member's own account, not a route to collect public money. And this is the biggest difference. Trading with your own money and unofficially moving someone else's money are not the same thing. Now think about it. If an investor or trader is told, you don't need to open your regular retail account, don't waste time on KYC formalities, we will give you a direct setup, then at first glance, it may feel like a convenience. Many people make the mistake right here. Because in a regulated market, a trading account, KYC, client registration, documentation, and the broker-client framework are not a formal burden, but a safety wall. SEBI TY's and NSE's investor education material clearly says that a new investor has to complete KYC and account opening forms while opening an account with a registered broker. This same process later becomes proof if a dispute happens. Where this basic layer itself is missing, risk has already begun from day one. According to reports, the riskiest part of this alleged prop trading network was the informal leverage arrangement. That means the trader's actual capital was one thing, but the exposure being shown to him for trading was many times more than that. Under what agreement that exposure was given, under which rule it was given, and inside what regulated structure it was given. These are the questions that are most serious. Moneycontrol's report said that in many cases agents were allegedly in the middle, who were not official employees of any broker or SEBI-registered intermediary, and yet were arranging leverage and access. Many transactions had no proper audit trail. Some amounts went into third-party bank accounts, and in some cases even cash dealings were spoken about. In such a model, the biggest problem is this. So long as the market moves in favor, the system looks smooth. But the moment losses come, every weak link starts becoming visible. To understand this whole setup, remember one simple thing. The legal framework in the market exists so that client money and broker money do not get mixed. In SEBI's regulatory framework, member brokers are clearly required to keep client funds and their own funds separate. What this means is that the broker's own risk and the client's money trail can be identified separately. If any structure develops in which this boundary becomes blurred, then the danger does not remain limited to one trader. It can become a system risk. That is why the regulated ecosystem puts so much emphasis on documentation, segregation, and traceability. But then why do people get trapped in this? The answer is hidden in market psychology. Human beings get attracted very quickly to fast money, special treatment, and a secret edge. If someone is told, a normal trader trades with limited capital, but smart traders play a bigger game using leverage, then the listener does not hear it as a shortcut, but as an opportunity. Then he sees some green screenshots, some WhatsApp chats, some P&L snapshots, some success stories, and he feels that maybe he has found that very path which ordinary people do not get. This is where the most dangerous move of scam culture works. It builds trust before greed and illusion before trust. In such alleged networks, the language is often chosen very carefully too. Words like high probability trades, operator level information, smart money access, special limit, internal setup, VIP desk, funding line, interest sharing, and profit split sound sophisticated. The other person starts thinking that maybe he is becoming part of some advanced institutional setup. But in regulated finance, the identity of sophistication is not fancy words, but documentation and accountability. Where registration is unclear, there is no agreement, fund movement is not transparent, and the dispute mechanism is not defined, shining words actually become warning signs. Moneycontrol's reporting also showed that some traders and brokers came forward from different cities, and this pattern was not limited to any one locality. The discussion that began in Surat appeared to spread to Mumbai, Delhi NCR, Rajasthan, and other cities. In such cases, the biggest difficulty is that in the initial phase, the victims themselves also remain part of the system because they feel profit is coming. No one raises questions as long as withdrawals remain smooth, positions keep running, and the network stays active. But the moment default comes, the leverage chain breaks, payments get stuck, and the illusion of profit begins turning into panic. One more thing needs to be understood here. Prop trading in itself is not illegal if a regulated member is doing it with its own funds, within the rules, and inside the exchange framework. The problem arises when the name of a prop account is used to attach public money or unofficial funding to it, and outsider traders are given such exposure that is running without proper client onboarding and compliance. That alleged misuse becomes a regulatory concern. So while understanding this kind of matter, it is extremely important to understand the difference between trading and regulated trading. Not every trading terminal gives legal protection. Not every profit screenshot gives genuine safety, and not every market operator is a regulated intermediary. Imagine the story of a trader. He first entered with a small amount. He was told, "Your capital is safe. Just think of it like margin." In the beginning, some trades remained profitable. With growing confidence, he added more money. Then he was given a bigger limit. Day by day, he began feeling that he was no longer a normal retail trader, but part of a bigger game. But the real questions he never asked. Whose name is the accountant? Whose risk is it? Whose legal liability is it? Which regulated entity is holding the funds? How will exit happen? Where is the agreement? Where will the complaint go? In the market, the costliest losses often come not from the wrong trade, but from the wrong trust. And when loss comes, the story changes suddenly. The same people who were selling confidence until yesterday begin picking up calls less often today. The setup that was described as like family suddenly starts using market risk as an excuse. The trader cannot understand under what legal structure his position existed. The broker may say the arrangement was unofficial. The agent may say he only connected the parties. If the bank trail is incomplete, recovery becomes even harder. At this stage, the victim realizes for the first time that he had not taken trading risk, but structure risk. And the damage from structure risk is often even more painful than market loss. Over the past few years, SEBI and the exchanges have taken many steps towards strengthening investor protection, fund segregation, direct payout, and monitoring systems. The purpose of these reforms is exactly this: that client assets can be better shielded from broker-level stress or misuse. But the reach of any regulator remains strongest only where the transaction is documented, the entity is regulated, and the trail is visible. If people themselves begin trusting informal networks, unofficial accounts, unregistered intermediaries, and verbal promises, then later the process of protection becomes long and difficult. That is why compliance may feel boring, but investor safety is hidden in that very boring system. The moral lesson of this alleged prop trading network is not just don't be greedy. The matter is bigger than that. Very often, people are trapped not by greed, but by aspiration. They feel that in order to move ahead in the market, they need some shortcut, some special desk, some hidden leverage. Social media makes this illusion even stronger. Everywhere there are profit screenshots, trading reels, luxury lifestyle clips, laptop trading setups, and instant success stories. Slowly, the difference between genuine investing and performance theater begins to disappear. Then the person starts seeing the regulated path as slow and boring, and the unregulated path as smart. That is the biggest trap. The truth is that real edge in the market is not flashy. It is hidden in boring discipline, risk control, position sizing, compliance, taxation clarity, and process. Any setup that from the beginning runs away from paperwork, avoids KYC, gives no official contract, asks for payment in a third-party account, offers unrealistic leverage, uses a tone that sounds guaranteed, or asks for extra money for withdrawal. That setup does not ask for a chance, it asks for caution. In regulated finance, transparency is not a cost, it is protection. Any model that is avoiding transparency is often avoiding accountability too. This whole matter has brought forward one more serious thing. In a growing financial market like India, trust is a very big capital. New investors are entering the market for the first time. Participation is increasing from smaller cities. Derivatives, online broking, and mobile apps have made access easier. But the more access increases, the more the paths for misuse increase too. That is why investor education is no longer an optional thing. It is just as necessary as capital itself. Because in the market, it is not enough to look only at return. You also have to look at the route. The wrong route can look like the right return, but in the end it can damage capital, confidence, and credibility. All three. And perhaps that is the biggest fear in this story. The loss is not only of money. The loss is also of trust. When a person gets hurt in the market because of the wrong network, many times he starts becoming afraid of the entire financial system itself. Then, genuine investing, proper broking, long-term wealth creation. Everything starts looking doubtful. That is why it is not right to dismiss such alleged cases as just isolated incidents. They need to be learned from. It is necessary to understand that in the market, the shine of shortcuts often comes at the cost of safety. So if any setup feels too easy to you, too secret, too exclusive, too profitable, and yet too poorly documented, that is exactly the moment to stop and think. Ask, where is the KYC? Where is the registration? Where is the written agreement? In whose name are the funds going? What is the grievance redressal? What is the legal trail? What is the risk disclosure? Because in the market, the smartest question is not how much profit will I make, but if something goes wrong, where is my protection? In the end, this prop trading scam story teaches us one direct thing. In the world of finance, not every shine is an opportunity. Many times, it is only an illusion, polished with the colors of trust, urgency, and profit. Whether it is Hyderabad, Mumbai, Delhi NCR, or some small city, the pattern remains almost the same. It starts with confidence. In the middle, greed and trust get mixed together. And in the end, the same question remains that should have been asked at the beginning. Was this entire system really legal, traceable, and safe? That is why before learning to win in the market, one has to learn to stay safe. Not every big return necessarily came from great intelligence, and not every big loss necessarily came from the wrong stock. Many times, the biggest mistake is choosing the wrong structure. So real smart money is not the one that finds the most leverage, but the one that checks legitimacy first. And perhaps the biggest exposure in this entire matter is also this. Many times a scam is not hidden in the numbers, but in the absence of process. If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.